Hello and welcome to our end of December and end of the year update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple, battle-tested methods of investing that require just one adjustment each month to protect and build wealth. This is our special end of year summary. And what a year it's been. For those of us in the US, the Federal Reserve Bank actually ended QE, normally bearish for the markets. Oil and gold prices crashed. Russia's economy crashed after taking over Crimea. Chinese growth slowed more than 25%. A terrorist group, ISIS, took over much of Iraq and Syria. And Ebola. And yet, the stock market still went up this year. Who would have thunk it? Yes, you can say that gold crashing was actually good and that paper US dollars actually were worth more, which means stocks were worth less, but it didn't. And yes, you can say that even though QE stopped, the effects of stopping QE is likely delayed and we might not see the effects until next year. And on and on. Truth is, you can mentally masturbate all you want about the causality of news and world events on the markets, and you'd find that for the most part, all these chairs on the Titanic matters little, if at all. As a famous Dr. Kindergarten cop Arnold Schwarzenegger once said, "It's not a tumor." You know of hypochondriac patients who read too much internet and come in thinking they have cancer or Chuchukamusi disease. Same with hypochondriac investors. Oftentimes only a few key pieces of information is needed to formulate an appropriate course of action. Remember that probabilistic forecasts become less reliable with longer time horizons, and emotions cloud our forecasts. So how did our mechanical, non-emotional systems do this year? Here is our 20-month moving average system. Prices of our index fund is still way above our 20-month moving average. It's still safe to be in stocks in general, and specifically in the S&P 500 index fund. And this is just a graphical representation of the model of what happens when it rotates out of stocks when the index dips below the 20-month moving average. You can see how, with the yellow line, when we sell the fund, we get these flat lines when we're in cash. And this green line shows what happens if we rotate out of the stocks and into VUSUX, the long-term treasury bond fund, instead. So how did this model work so far? If you look backwards at 1 year, we've been fully invested in stocks, so all three models made 12.9% this year. What about 5 years? This was when stocks was still dropping and was just about turning around, but didn't quite cross the 20-month moving average yet, and that's what caused a bit of a drag in our stop out and rotate models. You can see that because of this little whipsaw in 2010, this whipsaw caused drag. In 10 years, because this model was able to avoid or mitigate most of the bear market of 2007-2008, the annualized percentage stays high. If you go back 21 years, the model stays high. And yes, just a 4% annualized difference between the buy and hold and pray model and the rotated bonds model showed you more than doubled your returns over 21 years. Remember that when you take a loss in the markets, even if the markets do recover eventually, you lose your most precious commodity, that is your time, to get it back. Now for the MRI, monthly rotation investment system. The black line is the S&P 500 index, the yellow line is the inverse fund, and the red line is emerging markets. And there we have it. The US markets and the inverse fund were neck and neck for most of the month until finally, the very last day of the markets dipped, giving the inverse fund the advantage. And yes, usually funds have dividends around the 20th or so of December. So make sure to take that into account, but for some reason this year we didn't get any dividends for December. Still, going by the book, rotate a quarter of our model portfolio now into the short fund, like so. But wait, the stocks and inverse funds are so close. Had the year ended 1 day earlier or had the dip occurred 1 day later, we'd be rotating into the S&P 500 fund instead. you might be thinking. And yes, you'd be right, and lo and behold, the system has effectively neutralized the portfolio right now. 1/4 inverse funds neutralizes 1/4 of the S&P 500 fund, giving you equivalent of cash, 1/2 cash and 1/2 S&P 500 fund, meaning that we're effectively investing only 1/2 of our portfolio in these uncertain times, for this month at least. So how has this model done so far? Again, here's a graph of the model, backtest the beginning of the inverse fund in May of 1994. In theory, there was no way to invest this way before them without using futures or directly shorting individual stocks, because there was no inverse fund. So again, by cutting out and mitigating these big bear markets of 2002 and 2007, we boost our returns to 13% average for the last 20 plus years. Notice that there is one, quote, weakness, close quote, of the system, in that during times of raging bull markets, like here and here, the system underperforms the S&P 500 index. You can see why. When either the S&P 500 or the emerging markets becomes choppy, in other words, goes sharply up 1 month and sharply down 1 month, it drags the system with its whipsaws. If you think about it, there are only 3 things a market can do, and that is go up, stay flat, or go down, and it does so at varying wavelengths. Recall from pre-med physics that waves come in different frequencies and wavelengths. Markets almost never proceed in a straight line. There are moments of up followed by moments of down. If these up and down moments just happen to be at wavelengths of about a month, we will get whipsaws. Do wavelengths happen much faster than once per month? Yes. Much slower than once per month? Yes. So while the weakness of a buy and hold and pray system is the inevitable downturn, which can wipe out much of your portfolio and take time to recover, the weakness of a monthly adjustment system is that we will at times have monthly whipsaws, which will temporarily drag down market gains, but at least will severely mitigate, if not reverse, bear markets, the whole reason why we're in the system to begin with. And now for something completely new I'm adding, the Ray Dalio Pie Chart. I'm not going to put this in my book since it's already well described in Tony Robbins' new book. For those of you who have read the book or know Ray Dalio, he's the uber guru of hedge fund managers. Where most hedge funds of more than $15 billion is considered big, Dalio's hedge fund is $160 billion. He's so big and top dog that presidents and heads of state of various nations keep him on speed dial. He's so big and successful that he won't invest for us mere billionaires. In fact, he hasn't accepted new investors for almost 10 years now. Tony Robbins happened to get his foot in the door with Dalio because Dalio just happened to be a fan of Tony's for over 20 years now. If you've ever gone to one of Tony's events, you'll know why. Believe me, his books, audio tapes, and videos published out there do not do him justice. Tony convinced Dalio to review his secret sauce, and his approach to risk management is intriguing. There are basically only 2 variables that really matter in the markets. That is, whether there is inflation or deflation, or whether there is economic growth or economic stagnation. And certain asset classes do well under certain conditions, and they do overlap in an interesting complementary pattern. Based on this relationship of the asset classes, relative risks can be balanced out. Now, for years, hedge fund managers have known about Dalio's theories in theory, but have never been able to put it together in a way to rival Dalio's track record. Keep in mind, Dalio has delivered more than 20% returns every year for decades, dwarfing Warren Buffett, but he uses derivatives, hedges, and leverage. If we boil down Dalio's secret sauce to something us peon investors can do, it boils down to this pie chart. At first glance, you look at the pie chart and go, what? Only 30% stocks? You're kidding me. And huge bond holdings. And what? Commodities? So I backtested this. Now, Ray, when he says intermediate term treasuries, he means 10-year bonds. I couldn't find a good fund with 10-year bonds, so the best I could come up with is this 5-year intermediate term bonds from Vanguard. And as for commodities, there are several indexes out there. I chose the UBS Commodities Index because it contains 22 commodities, one of which is gold. Most commodity indexes include gold, so we'll have to accept the fact that we're going to be a bit top weighted in gold. But watch what happens with this pie chart. Okay, big deal. Over 22 years, the average return is only 8.2% compared to 9.2% for stocks. But watch, over 22 years, there were only 3 down years, all less than 3% each. Even in this mega bear market of 2008, where stocks lost a lot, losses were mitigated. And when I tried to sector rotate this pie chart, sure, I could improve the performance a smidge, and all my improvements result in short-term capital gains, whereas most of the pie chart gains are long-term and need not be cashed in until you really, really need the funds. Assuming a 40% tax bracket, this 8.2% annualized gain is equivalent to 13.7% before taxes. So one thing to consider is you can use one of the once-a-month systems that give you 13% per year average in a tax-advantaged account, such as a Roth IRA. But if you were to invest outside a tax-advantaged account, I would consider the once-a-year rebalanced Ray Dalio pie chart. Not advice, just to raise awareness. Dollar cost averaging? Just a reminder, it's the beginning of a new year. Make those IRA deposits. If you haven't set up automatic deductions for your pension, there's no earlier time than now. The only common rule of all books on how to save and invest for retirement is to spend less than you make. And one way to implement that is to pay yourself first, by contributing to your savings and investing accounts, if at least once a year. And the 1% risk trailing stop? This one is highly individualized and dependent on what stocks you choose to own. You know the formula. To risk no more than 1% of your capital on any one stock, use only 4% of your investment account to buy the stock, then use a 25% trailing stop loss on it. And when the stock goes up 33%, go ahead and buy another block of stock with another 4% of your account, and be sure to update your trailing stop order to reflect the new quantity to sell. Phew. Again, we have new viewers, so here's an example of how I round on my stocks. I do it weekly. I suggest you do it at least monthly, not so much to know if your stocks got triggered to sell, but to see if it's time to buy more stock. For instance, in this particular account, you can see that I have several positions I've blocked out, but each position there's either an asterisk or a percentage sign which tells me what kind of stop I put in. Average price, price currently, my notes, for instance, the source where I got the stock tip from, instructions, for instance, this one says buy more at $34.16. Right now, price is 37, so it's time to buy more. Other positions, all with different notes. The value and gain or loss. Over the last few months, several of these positions have been going down, but they haven't been stopped out yet. There were some positions that did get stopped out, but that's the whole point. You mitigate the losses while you keep letting the winners keep growing. So overall, even though total positions are roughly equal, the gains have far outpaced the losses for net gain so far. And here's an example of how to set a trailing stop order. Typically, you go to your trade tab and you choose stock. Then you go to your stock order page and enter the relevant information. The ticker symbol, quantity, and finally advanced orders, trailing stop. At your trailing stop stock order page, you can trigger the number, specify percentage, go until canceled, press the preview order, make sure your order is correct, then click on send and you're done. So that's it in a nutshell. Hope your 2014 year was fantastic and hope 2015 will fill you with hope and joy. Accumulate magic moments in your life in your journal. The wealth in your journal will dwarf any wealth in your investing accounts. Success without fulfillment is the ultimate failure. And until next month, invest safely.